Take action to protect yourself now, as the current inflation is not a recent phenomenon. It has been ongoing for approximately 90 years, dating back to 1933 when the dollar-gold exchange rate was fixed at $35 by Franklin Delano Roosevelt or one of his advisors. This change from $21 to $35 caused deflation and stabilized the price system at the time. However, since then, there has been constant money printing and a dishonest representation of the gold-dollar exchange rate until 1971 when the truth was finally revealed. After realizing that the gold ounce was not exchangeable for $35, the truth was revealed, and the constant inflation that began with the change in 1935 has continued for about 90 years. However, it's doubtful that this inflation can persist for another decade. In the 1990s, when I was a child, people were not burdened by debt to the same extent as they are now. I lived in a middle-class to upper-middle-class area where people had savings, were mobile, and enjoyed a high standard of living. However, things changed around 2006 to 2007 when people began accumulating debt to purchase homes, and these debts are still looming over them. Many people today are struggling with debt. I don't personally know anyone, except for the wealthy, who is not significantly in debt. During times of crisis, such as the one we may be facing, it's common to experience a grinding effect. It's difficult to say how long this process will take. It could be a few months or up to a year. There are numerous complex factors at play in the monetary system that could cause unexpected consequences. Based on historical patterns, I predict that we will see a gradual decline in the dollar's purchasing power, not just in relation to other currencies, but in terms of the real-world goods that it can buy. As time goes on, things will become increasingly expensive. The vast majority of people, including many staunch supporters of fiat currency, generally agree with this assessment. The current system of accumulating debt is unsustainable and everyone knows it. It goes against the natural balance of things where things tend to balance out. The system only accumulates and never goes down. It is just a matter of time before it implodes. When the dollar starts losing its purchasing power, it will happen fast, just like in previous cases of hyperinflation. The difference this time is that it could affect the index currency itself, causing the entire monetary system to implode. This could result in the breakup of private monies, which could be better in the long term, but chaotic in the short term. In previous cases of hyperinflation, it took time for physical paper to be distributed throughout the country, which slowed down the process. With modern technology, payments are instantaneous, and the impact could be much more severe and rapid. Bitcoin and other forms of digital currency could be an alternative to the dollar, but it is uncertain how they would fare in a hyperinflation scenario. It is possible that food prices could double or even triple within a few months, and then suddenly collapse. We have not witnessed this level of quantitative impact in the current technological landscape of money transfer before, although we have observed qualitatively similar occurrences. It is difficult to predict the exact outcome, so it is wise to take precautions in advance. The value of the dollar is based on its ability to be exchanged for a certain amount of gold, but if everyone were to trade in their dollars for gold, the value of gold could rise significantly to around $40,000 per ounce. This estimate is based on the ratio of the Federal Reserve's balance sheet to the amount of gold in Fort Knox. During the Great Depression, gold prices increased from $21 to $35, causing economic turmoil. If gold prices were to rise to $30,000 per ounce, the resulting depression would be catastrophic, and it is best not to dwell on such a possibility. The rise in gold prices is not the primary concern. Rather, it is the collapse of the dollar and its loss of purchasing power. If the exchange rate between gold and the dollar were suddenly raised to $5,000, people would likely rush to exchange their dollars for gold, and the rate would continue to increase. This presents a significant danger because the decline in the dollar's value will not occur gradually or in an orderly manner. It could drop suddenly from $2,000 to $3,000 or even higher, making it challenging to predict the exact numbers. Under this scenario, commodities priced in gold would appear relatively inexpensive, as gold is the actual currency. The main concern is not the price of gold itself, but rather the potential consequences of a collapse in the dollar's purchasing power. The value of the dollar comes from the gold that supports it, which is not at a fixed rate but still provides a backing that can be exchanged for gold. Once the exchange rate reaches $4,000 or $5,000, the free market will push the dollar toward its monetary parity, which is determined by the ratio of the Federal Reserve's balance sheet to the amount of gold in Fort Knox. This process will happen swiftly once the rate hits $5,000, and the vast majority of people, even those investing in Bitcoin, will be affected. Many people don't understand that when we exchange money or currency for goods such as food, houses, or cars, we are effectively exchanging gold. This exchange of gold is not something we are consciously aware of. The large financial institutions that speculate on contracts are taking significant positions in gold and liquidating them to earn dollar profits. These institutions do not view gold as money and do not set its price. Financial institutions view gold as a shiny store of value, but they use various descriptions of what money can be. Money is not only a store of value but also a unit of account, among other things. Gold serves as money when used for purchasing goods or services. Even if a gold substitute is used, it still represents gold in some form. The current price of gold in dollars primarily reflects its industrial value rather than its value as money. When everyone needs actual money, they will turn to gold, and the price of gold in paper money could reach as high as $30,000. The reason why gold is money goes back to the fundamentals of how money began. It's a simple concept: you wake up in the morning and know what you're going to do. The knowledge of how much money one has and needs to make or spend comes from day-to-day experience and information. This understanding is necessary to maintain one's standard of living. No government or entity can simply create a currency system and dictate prices, because determining the supply and demand of goods and services requires market action. Coordination between people based on what they have, need, and can spend is necessary to understand the available resources and demand for them. Creating a monetary system that is not indexed to something else that already exists is not possible. Money began as a means for people to trade goods and services with one another. Gold and silver were the easiest things to trade because they were not controlled by a central authority. Every paper currency was born from this idea.